Brace yourselves for a riveting dive into the financial and geopolitical landscape. We're unraveling the severe market implications of tension in the South China Sea, with expert predictions on potential conflicts, the economic fallout, and defensive strategies. Join us as we decode whether the Chinese real estate downturn will actually destabilize the economy and find out why some economists are pushing to end the Fed. Hit that like button and subscribe for critical insights you won't want to miss. Today, on Financial News and Review, we will summarize the following videos. From Blockworks Macro, we have Why the Chinese Real Estate Downturn Won't Sink the Chinese Economy, Ben Harburg. From Kitco News, we have WW3 likely triggered by this conflict as defense pacts kick in. It's not Mideast or Russia-Ukraine. From David Lin, we have Is the Fed Getting Abolished? Economist explains End the Fed Movement, Carola binder. Welcome to Blockworks Macro. Today's featured guest is Ben Harburg, managing partner at MSA Capital and portfolio manager at Core Values Alpha. Ben Harburg argues that while the Chinese real estate market is experiencing significant challenges, these issues are unlikely to drag down the entire Chinese economy. He believes the fundamentals of the economy remain strong, pointing to evidence that current real estate issues are manageable and not comparative to a Lehman moment scenario like the US faced in 2008. Here are the key points discussed by Ben Harburg, market differentiation. Ben emphasizes the difference between reading about China from abroad and experiencing it on the ground. Information asymmetry has led to a lot of misconceptions. He notes that while the Chinese property market is indeed troubled with considerable overbuilding and some developers defaulting, it doesn't reflect systemic banking risk seen in the US during 2008. Chinese government's approach. Chinese government interventions have been aimed at stabilizing key property developers without causing an economic meltdown. Policies are now allowing more people to purchase properties, albeit these measures come a bit late. Public versus private markets. Ben highlights the disparity between perceptions of public equities versus private markets. He suggests that public equities present an undervalued opportunity, while private markets may face liquidity crunches. Domestic and international investment. Ben underscores how local Chinese brands are quickly capturing domestic market share from international ones, driven by better adaptability and consumer preferences. On the international front, Chinese tech companies like ByteDance are making significant inroads, capturing substantial market share even in the US. Ben Harburg made the following predictions. Stock market rebound. Ben predicts a potential rebound in Chinese equities driven by a counter-cyclical environment compared to the US and improved investor sentiment as measures to stabilize the market take hold. Continued government intervention. Administrative measures, such as opening up new urbanization projects and easing property purchasing constraints, will continue to inject vitality into the market. Shift in global manufacturing. Ben expects China to reinforce its position as a global supplier by leveraging their highly efficient and cost-effective manufacturing capabilities, even in the face of international tariffs. Ben Harburg concludes that despite the current real estate downturn, the Chinese economy is far from collapsing. The stabilized public equity market, coupled with continued government intervention aimed at boosting consumption and employment, will ensure sustained economic growth. Finally, he urges investors to focus on fundamentally strong Chinese companies that are undervalued and poised for growth. Call to action: check out the detailed insights and further discussions about investment opportunities on Ben's website, benharburg.com. Welcome back to Kitco News. Today, Michelle McCory speaks with Hal Kempfer, CEO of Global Risk Intelligence and Planning, about the rapidly escalating tensions in the South China Sea and what it could mean for global stability. The core thesis of this discussion revolves around the significant, yet undercovered, geopolitical risk presented by the South China Sea. Notably, escalating tensions between Chinese and Philippine forces could draw the U.S. into a larger global conflict through mutual defense treaties, potentially triggering an economic catastrophe due to disrupted global trade routes. Here are the key points discussed by Hal Kempfer, CEO of GRIP Global Risk Intelligence and Planning. Geopolitical conflict in the South China Sea. Recent clashes between Chinese and Philippine forces have heightened risk in the region. China's aggressive stance against Philippine resupply missions, and territorial claims over the South China Sea. Economic impact. The South China Sea is a critical artery for global trade, carrying 44% of maritime container traffic. A major conflict or blockade in this region would lead to economic instability and increased global inflation. Mutual defense pacts. The US-Philippine Mutual Defense Treaty could mandate US involvement in any escalation. Japan and the Philippines are also strengthening defense ties, potentially heightening regional tensions. Hal Kempfer, CEO of GRIP Global Risk Intelligence and Planning, made the following predictions. Increased geopolitical risks. Hal Kempfer suggests that the current tensions in the South China Sea might not dissipate and could escalate further, drawing in more countries through various defense pacts. He emphasizes that an incident, intentional or accidental, could spark a broader conflict involving the U.S. and its allies. Economic consequences. Any conflict in the South China Sea, even without a full-out war, would severely disrupt global shipping routes, causing prolonged economic hardships and supply chain issues. Hal Kempfer concludes that the South China Sea presents a significant geopolitical threat with far-reaching economic implications, urging viewers to remain informed and consider the broader impacts of these developments on global stability. Michelle highlights the importance of financial strategies like investing in assets that can hedge against inflation, such as gold and Bitcoin, which are frequently covered on Kitco News. Welcome to another exhilarating episode on the David Lin channel. Today, we're diving deep into the discussion surrounding the Federal Reserve with renowned guest Carola Binder. Carola is an associate professor and chair of economics at Haverford College, not to mention an NBER research associate and author of Shock Values, Prices, and Inflation in American Democracy. So pull up a chair, because today's topic is hotter than fresh-baked bread. We're talking about the potential abolishment of the Fed and the heated movement behind it. The core thesis of this video zeroes in on the rising sentiment to end the Fed, examining the economic and historical aspects of this movement. The video delves into whether the Federal Reserve should be abolished, especially in light of its role in inflation and monetary policy during recent crises. Carola Binder provides an analytical perspective on the origin, implications, and feasibility of this controversial idea. Here are the key points discussed by Carola Binder. Abolish the Federal Reserve Act. Introduced in May, the act claims the Fed's monetary policies during the COVID-19 pandemic increased inflation. David and Carola discuss how the Fed's creation of trillions out of thin air and its impact on deficit spending has pained American wallets. Inflation trends. Carola mentions that current inflation rates are trending towards the Fed's 2% target and highlights the need for consistent data to gauge this trend accurately. The Federal Reserve's preemptive actions before inflation hits the 2% mark due to the lag in monetary policy effectiveness. Inflation expectations. Inflation expectations significantly affect inflation rates, even if it's tough to find strong empirical evidence for this relationship. Carola points to historical instances such as the 1970s, when de-anchored expectations caused significant inflation increases. Inflation targeting discussion about the Fed's 2% inflation target, its origins, and whether it remains appropriate. Carola offers insights into why changing the target to 3% could be disruptive and detrimental to the Fed's credibility. Accuracy of inflation measurement. Measurement errors and inconsistencies in BLS data and its varying illustration of inflation based on different household experiences. Challenges in measuring quality changes in products over time and how this affects reported inflation. Central bank independence. Carola's research shows a significant percentage of central banks face political pressure, even in countries with so-called independent central banks. Political pressures predominantly push for looser monetary policies, especially from populist governments. Carola Binder made the following predictions. Potential Federal Reserve rate cuts. Carola suggests that the Fed might cut rates by 25 basis points before the end of the year if inflation trends as expected. Further cuts might follow in the next year, depending on data. Employment and inflation goals. The Fed's dual mandate of price stability and maximum employment might remain under pressure, especially if rates stay high for too long. Summarizing the lively debate, Carola emphasizes that while the Fed's past actions are debatable, the complete abolition of the Federal Reserve is politically and practically unfeasible. Further discussion is warranted about the optimal inflation target and measures to ensure economic stability. So, whether you're rooting for or against End the Fed, understanding these complex dynamics is crucial. Don't forget to subscribe for more fiery debates and enlightening insights. In today's videos, Ben Harburg demonstrates optimism about China's resilient economy despite real estate struggles, advocating for targeted investments in undervalued Chinese equities. Hal Kempfer warns of escalating geopolitical risks in the South China Sea, emphasizing potential severe economic repercussions and disruption of trade routes. Carola Binder tackles the contentious End the Fed movement, criticizing the feasibility of its arguments and discussing optimal inflation control. Despite different focal points, all experts agree on the importance of strategic financial planning and staying informed on global developments. Stay tuned for more in-depth analysis and insights. Thanks for watching Financial News and Review for July 8th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.